The actual thing that everybody's picking up is the withdrawal of liquidity by the Federal Reserve. Right. The withdrawal of liquidity is what is moving this. So you take liquidity out, the price of assets goes down. And we will see the same in the equity market. Somebody's going to go bust. Or the bond market, somebody's going to go bust. That's very typical of the final stages. I also note that on Twitter, it's become monkeys flinging poo at each other, and everybody's losing their minds because everyone's stressed, right? It's a recession, everyone's losing money. That kind of mass anxiety is more of a signal that we're at the end of a move than the beginning of a move.
In today's video, I'm going to show you guys what happened to Bitcoin's price after the US CPI report, and what were the reasons behind the crash. Bitcoin has lost more than half of its value in May, since hitting an all-time high of $69,000 in November last year. While its latest crash was directly triggered by higher than expected US inflation data, I've noticed that there were also other factors for the decline. Before getting into the video, subscribe to my channel and hit that bell icon to never miss any videos. US inflation, the initial trigger. So you see, Bitcoin was trading around $31,000 prior to the US CPI reading last Wednesday, but since then it has dropped approximately $28,000 within minutes due to a higher than expected reading. I mean, it was really high. But let's first hear Lynn's view on inflation and CPI.
If you look over the past 25 years or so, historically, money supply and CPI, if you use, say, 5-year rolling periods rather than the noisy kind of year-over-year period, there generally is pretty strong correlation, but there are periods where you can have a pretty significant disconnect, and that's usually due to some rapid technological change. We've unlocked some new abundance that allows for, less inflation than you'd expect from the money supply growth. And so that happened, for example, in the late 1800s.
So guys, the dollar value of BTC was already dropping since the CPI of March came 8.5%. I mean, it's the highest since the last few decades, and people were expecting the CPI to be a little lower in April. But Wednesday's release showed that prices increased by 8.3% in April, which can be considered a bit of a satisfactory rate of reduction. But still, it is a lot higher than what we were all expecting.
And then you throw in always in a bear market, whether it's equities or whether it's in crypto, you throw in the old terminology that when the tide goes out, you see who's swimming with no shorts on. And that happened to be Luna. If you can't deal with a 60% drawdown from peak to trough in your bag, you shouldn't be in the space. We've all made it absolutely clear that this space is all about volatility. We're seeing a huge amount of activity. There's a huge amount of drama on a daily basis. But over time, we've been in a big, sloppy range. And that big, sloppy range is an up and down 50-60% range. That's been driven by macro. And I've said this for a long time. Crypto and macro are joined at the hip.
Now, this as well as the stablecoin Terra Luna crash in the market, where it crashed to $0, has caused the Bitcoin value to drop even more in the market. I mean, Bitcoin got as low as $28,000, when $30,000 was already a very sensitive point for it. Everyone anticipates that the Federal Reserve will quicken its pace of interest rate hikes in response to the higher inflation rate, and maybe they might.
But as far as the market, the million-dollar, trillion-dollar question is the Fed's reaction function, right? Because we know the cycle is going to slow. The forward-looking indicators are saying that with a pretty high degree of confidence. But is the Fed going to pivot, right? Are we going to have a December 2018 event, and is the Fed going to pivot? This time it's different, right? Because inflation's quite high. They say that they're not going to pivot until inflation comes down. I think that we have a huge gap. And this is sort of what I like to present to clients as the value that I provide, is these cyclical inflection points, right? And I think, as you mentioned, we are at one of these inflection points, because what I see right now, Raoul, is the bond market that's pricing in another 8 hikes. The Federal Reserve is saying we're going to do another 7 hikes, but the equity market is not saying 8 hikes, right? So there's a huge disconnect between what's being priced into the bond market, what the Fed is saying they're going to do, and what the equity market is saying. And some of these divergences you can pick up in some of the internals of the equity market. I mentioned utilities to regional banks. Utilities are hitting 52-week high, outperforming banks. But rates are rising, right? You would think if rates are rising, you wouldn't want to be in utilities, you want to be in banks. So the equity market there is picking up the slowdown. You look at things like housing, you look at something like even industrials to consumer staples, right? Industrials have been underperforming consumer staples. that's another growth slowing signal. So I do think that the equity market is picking up on this growth slowdown, but I don't think the Fed is going to pivot as quickly as they did the last few times. I think that they have a credibility issue that they have to sort of rectify here. So I think that there's a huge delta going on between bond market pricing, Federal Reserve guidance, and equity market pricing. The divergences in the internals are suggesting that, and I think that that gap closes with a drawdown to risk and a rally in rates.
Increasing interest rates by the Federal Reserve could be one of the main reasons for this decline. As the Fed continues to raise rates, it becomes more expensive for investors to hold on to Bitcoin and other cryptocurrencies. This has led to even more sell-offs and potentially causing a crash in the market. Before getting ahead to other reasons behind the fall, give this video a big thumbs up. Ukraine War. Volatility is nothing new to Bitcoin, but the events of this year, including multiple crashes and the Ukraine war, have caused some investors to lose faith in it.
I think in this cycle, we get the peak surpassing the prior peak, and that's the most concrete outcome of these secular changes. Now, obviously what's happening in Ukraine complicates that, and there are tail risks there that I appreciate. If we can put that to one side, which is, in a real-world sense, almost impossible, but prior to Ukraine, I was absolutely telling people that we would see interest rates in the US go higher than we have seen for several years. It would be the first time that we've seen a cycle peak exceed the prior cycle peak. It's still my base case, but with a little less conviction because of what's happening in Ukraine. As we came out of the GFC, the market was saying, you know what, the long run real Fed fund rate can be 2 to 2.5% positive. And that was what they were also pricing prior to the GFC. So no change. Despite the depth of the downturn, we were going to go back to a world where ultimately the neutral rate of interest was over 2% real, and we would have positive real rates on average through the cycle. It was only when you had the euro crisis and austerity in the US that the near-term rate expectations collapsed and people moved to assuming lower for longer. But even then, they were expecting that we'd go back to real positive rates in the long run. Last 2 years, that real long-run Fed expectation has turned negative. So we have markets now that are no longer pricing lower for longer, they're pricing lower forever. We never get out of this.
If you go from, say, the early 40s to the early 50s, when you had that kind of final inflation spike, you had about 6% average annual inflation, but it was very bumpy. You had literally, at one point, technically 19% year-over-year CPI, but then the next year you'd have like 0 or even like mildly deflationary. Then you'd have another spike. And so I kind of characterize this period similar to the 40s. The one thing that might be similar to the 70s is the energy situation. So what made the 70s also unique, besides the demographics boom you had, is that U.S. domestic oil production peaked in 1970. So we had this kind of nearly a century-long continual expansion, more or less, of U.S. energy production. That peaked in 1970, and so the U.S. became more reliant on the Middle East at the same time as we were going through that very big demographics boom. And that's what fueled inflation, because you had that supply.
Yeah, you had a supply and demand shock at the same time.
Exactly. Whereas now we have less of a demand shock, obviously, but we do have a supply shock. And so I think we have 40-style monetary and fiscal policy combined with not unlimited commodities, right? So that's where we get this more inflationary environment from. So I think the 40s are a similar environment, especially you could say, right now the United States looks like the 1940s UK, because back then the United States was running structural trade surplus. We looked more like China in some ways, right? We were the rising power, we were the export place, whereas the UK was more of the established power, the structural trade deficit, and going through the same sort of wartime financing.
I agree with both of them. You see, much of the deceleration in CPI for April came from the volatile energy component, especially since the prices for crude oil, gas, and other energy commodities have spiked so high immediately following Russia's invasion of Ukraine. Equity markets tumble, BTC follows.
It's expensive because if you take the politicians at face value, which I think on this one we probably should, they're all going to have to secure their stockpiles of gas, and we could go down the commodity list, and not forgetting fertilizers as well, which are kind of important. And that's going to underpin prices. You can argue whether the Fed's behind the curve or not, but you would have thought one of my priors was if the Fed's going to hit things hard, as they are, credit would be falling apart like a bad meatloaf, right? And there's been some widening in credit. There's been higher risk premium in credit. High yields been hit a bit, but it's all come back down. You have, of course, seen a very abrupt rise in 30-year fixed rate mortgages in the United States, which at some point will put a bit of a brake on the ability of US households to refinance and put a bit of a crimp on consumption as intended. But mortgage-backed spreads have widened a little bit. Well, they've widened abruptly in some parts, but nothing compared to averages of the past decade plus. And it's just surprising that the Fed is so overtly hawkish and people are like, nah, doesn't matter. And I'm like, we must be so close to the point where this does matter.
But it's in the price.
It's in the price, but is it in the price of everything? Now, on the one hand, if the Fed's going to be really hawkish, and you're making a good point, if the Fed's going to be really hawkish, then you'd expect, I think, the dollar to be a lot stronger. You'd expect credit generically to be a lot wider. But on the other hand, if the Fed's hawkish because the underlying economy is solid, which, believe it or not, I think it still is, then credit may not widen too much, because if the economy is on a solid footing, the cash flows will be there for all these borrowers to service their debt, and in some cases refinance if they need to. But I'm thinking more of equities, okay? We've got to be close to the point, I imagine, where some really important companies say, look, I'm sorry to report this, but we are running into severe supply chain squeezes, and in order to ensure production and manufacturing is unaffected, we have had to pay up for inputs, and I'm sorry to tell you, that is going to reduce our profit margins.
Inflation data released on Wednesday really did cause a large tumble in equity and stock markets. According to James, this increase is above the Federal Reserve's 2% target and has led to concerns of an increase in the interest rates, which would make it more expensive for companies and consumers to borrow money and could slow down economic growth. So you see, equity markets around the world reacted very negatively to the US inflation data. But if you like my video, do click that like button to show your positive reactions. Getting back to the video, Bitcoin really did fall to its lowest level as slumping equity markets continue to hurt cryptocurrencies. Now let's hear what Eric has to say regarding the market.
We have this secular decline that's still in place. We're coming off the back of what was an unbelievable cyclical upturn, but now we're going to start to have we're going to move down the backside of that cycle, right? At the same time that the Federal Reserve is tightening, and quite aggressively, might I add. So that's going to set up what I think is a huge risk pocket in asset markets. I think that the internals of the equity market are saying this loud and clear. You look at things like utilities relative to banks. Utilities are outperforming banks, but rates are rising, right? That's an inconsistency. You look at something like housing stocks. Housing stocks have been getting absolutely hammered. And you say, well, of course, because mortgage rates are rising, but where housing goes, the rest of the cycle goes, right? So if housing stocks are going to get hammered under the pressure of rising mortgage rates, that's likely to feed through the rest of the economy. So I think that the internals of the equity market are very much picking on what's going to be, in my opinion, a very sharp cyclical slowdown.
Bitcoin has fallen more than 20% over this past week. The faith in Bitcoin has coincided with a broader slump in the stock market. The S&P 500 slumped 1.7%, while the Nasdaq Composite, which is a closer parallel for BTC, tumbled over 3%. Apple shares have also fallen more than 3%.
You notice since the Fed meeting the last, 2 weeks here or something, it's been Qs that have been outperforming again. And I think that is also, again, consistent with slowing growth. Right? When
crypto the world as well, it's exactly the same thing.
It's exactly the same thing. I view crypto in very much the same lens as that, as sort of a risk-on asset that benefits from the falling real rates, right? So real rates are rising based on some of the feeling that the Fed's going to tighten soon. But I think that the equity market is starting to pick up on that growth slowdown and the eventual decline.
So you see, due to the high record of BTC's correlation with US stock markets, losses in equities have kind of spilled over into Bitcoin and other cryptos. Volatility in the market is often a result of speculation. Bitcoin is dropping in price alongside the rest of the markets. People are making speculations as to how much action the Federal Reserve may take in order to bring inflation back down to its 2% target. So to conclude, right now, Bitcoin and other cryptocurrency prices are getting affected by the general market sentiment, which includes inflation, Terra Luna crash, volatility in the market, and Fed interest rate hikes. And this significant price decline would cause many people to question the long-term viability of Bitcoin and other cryptocurrencies. While it's still too early to determine whether or not Bitcoin is in a bubble, there's no doubt that the current price decline has caused many investors to lose money and faith in the crypto market. To know more of the latest details of the market, subscribe to my channel, and don't forget to hit that thumbs up. I'll see you in my next video.